The Edgeless Horseman here. It's still October the 20th, 2022. This is the second video today. I'll touch more on uh, direct stock picking, let's say, in this video. I mean, I think there are a few concepts that are very beneficial at times like this when price volatility makes people, doubt what they're doing, doubt the fact that, if you're buying, if 10 days straight price goes down, it doesn't look like it was a good buy, and it's very hard to stick out over the longer term. And I mean, investing is all about the longer term. There's no edge in the short term because that's where everyone else is playing, and certainly the big returns is always taking a longer time view, unless you're into very high leverage options or something like that, which I certainly don't like leverage or margin at times like this, where basically you see entire first world economies on the brink of uh, going bankrupt. So that would be too greedy in my book. Not worth it. The risk reward is not there, in my opinion, because anything could happen at a time like this, like we're seeing. I mean, there's stuff happening in the market that has not been seen for 40 years, like inflation, or the 60/40 portfolio having the worst year ever, I think. I mean, ever. So again, it's like we're in uncharted grounds because we've never seen a global financial system like this. So I don't think it's the time to be taking long shots and stuff like that, because I mean, there's no more obvious play, in my opinion, than precious metals, and the miners just happen to be extremely undervalued, even extremely undervalued relative to the metals. Anyway, I mean, one thing I think is kind of important, or is something to think about at least, is like, which companies would you actually want to own personally? I mean, that's a great way to get conviction. I mean, if you ask yourself, like myself, for example, I bought some micro cappers that are down 90+% recently. I think some are trading between $5 to $1 million. Those are down a lot, and typically, like we know, Bob Moriarty recently stated in an article, it's typically the crap with the crap management that tends to move up the most when we go from a low to a high. They can go up 500 to 1,000%, not easily, but quite easily if they're around. But it's important to make the distinction that, first of all, because something is down doesn't make it cheap. I mean, most juniors, there are a lot of juniors out there that are down 80%, and a lot of the juniors are actually probably worthless. If you give that management team long enough time, they're gonna destroy all the value of the shareholders. Any private placements you give them, that's gonna be value destruction, not value creation. So there's a huge difference from that perspective. I mean, time is the friend of a good management team. Time is the enemy of a bad management team, because they're gonna create more problems and again destroy value. But I mean, if you can think about it, which I mean, we know Warren Buffett lays it out like that. That I mean, most people, and I find myself doing that, we look at stocks as pieces of paper, or digital trading sardines. We see them on the screen, we buy some, and then hope the price goes up. Whatever. We're looking more really, or most people look more at what the stock is doing than what the company is doing. And that's on the same line. I mean, I bought some companies that are down a lot because I know they can go up a lot if they're around for the next sentiment high, which we know 100% guarantee will come. Because there's through the history of the markets, no trend lasted forever. They can be very long and they can be very extreme, but they don't last forever. But which companies in your portfolio would you like honestly say that you would be happy to own 100%? If you have some companies like that, I mean that really is the best conviction you can have. That you really like, yep, I would be comfortable if all the team members, all of the management team, etc., directors, people in the field, their project, yada yada yada, if I owned 100% of that. Because that would suggest that you think they have a great business. They are creating value. The value of the company will probably go up. That's not a trading sardine. That's like you know when you can really see, yes, I think this is just gonna become better and better, more valuable with time. And another way it's like to look at is there, you know, how many companies do you own which you would actually, you know, be comfortable owning for 3 years? If the companies you own right now, it's like if someone said you can sell a share in these for 3 years. I mean, how many companies would you throw out of your portfolio? I imagine a lot. Or take 5 years, for example, because that will give you know an iffy management team even more time to hang themselves. So in that case, I think one would naturally be inclined to value, you know, management very, very high, and you know, stuff like, you know, skin in the game, access to capital, pipeline for growth, jurisdiction. I mean, you preferably want to still be the owner of what you owned 5 years ago, you know, or today 5 years later. Another one thing to think about, which helps bring conviction, is like, you know, thinking yourself like an asset baron. I mean, you are buying assets. You're buying part ownership of assets through buying stocks, which, you know, pieces of paper. But in reality, you have a claim on a partial claim on all of those assets. So I mean, when you think about it, like, you know, there's, let's say, a great deposit out there, great management team, great profile for growth, and you see price just goes down and down. I mean, what that means for most people, that means, okay, pain, my paper stock is going down, or my digital stock is going down. But at the same time, it's like it's even easier to buy a larger percentage of all the assets. The price of the assets are going down. The value of the assets typically, you know, does not go down at the same rate that they're going down now in a crash. And I mean, I've looked at some, you know, real micro cappers, and it's just, I mean, it's kind of surreal that some are so cheap. It's like I could literally buy whole companies right now. So when you think of it like that you when you could actually become the sole owner, I mean, theoretically, if you put in a bid or was able to buy 100% of the shares, then it is obviously a lot easier to think of it like an owner. Like, would I want to buy this entire company? But that also, I mean, when you're able to pretty much do that kind of tells you how cheap some of these companies are. But it's harder to do that when you're like, you know, you're buying shares of a 500 million market company. It feels like you're actually not buying partial business because your stake is so small. But it's still akin to, I mean, if you adjust for your shares, or I mean the money you put in, it's still pretty much like you're buying the whole company. It's just that you're paying, you know, 1/1,000,000th of a percent for it, so you get 1/1,000,000th of a share of the entire company. But it's, I mean, otherwise it's pretty much the exact same thing. It's just that you don't solely you alone do not own the whole company. Anyway, I think these are things to really think about right now. I mean, again, it's like there's no shortage of juniors out there. But there's a shortage of, let's say, good companies with great management, skin in the game, access to capital pipeline for growth jurisdiction. And a declining sentiment, a sector crash, does not care really what type of company it is. A lot of good companies go down, or a lot of companies that have created a lot of value have stayed flat. So it might not appear that some companies have gotten cheaper because they haven't gone down as much as some others, but a company that is down 30% might be cheaper than a company that's down 80%. And typically, like some of the market cappers I picked up recently, and we're talking really small stakes here, like 0.1% of my portfolio. It's just for fun, a bit like that, for fun. It's like, yeah, I know some of these companies will not be around. I know some will probably go up 1,000% in 2 years or something. But it's not going to have a material impact anyway. I just love the idea of buying cheap and low. That's what's the most fun. But on that point, it's like I find myself that I have to, because I'm such a falling knife hound. I mean, I love when I see something, and I've shown you a bunch of sectors, when they're down 90%. I mean, typically any sector that goes down 90%, I mean, they go up 1,000%, 2-3 years later. So I'm naturally drawn to anything that's down a lot, because that's where the big money is made, because no trend lasts forever. But at the same time, it's not good to just buy whatever that is down the most, because yes, they can go up a lot, but at the same time you can look at it. I mean, some will not, depending on how long this downtrend will continue, or rather the lack of capital continues. Some will have more problems than others. Some micro cappers might actually go bankrupt. But at the same time, if you spread bet 10 micro cappers right now, for example, I mean, maybe 3 will go bankrupt, 7 won't. And when we reach the next sentiment high, maybe the average return on those are 600%. So that's going to more than pay for the 2 that went bankrupt, obviously. So I don't think that's a wrong way at all to go about it. If there's a time to be looking at that, that's an extreme low in sentiment, which is obviously now. I recently had a K Report podcast where I touched on this. It's like, since I've been in alpha for a long time, at least the last 3 years, mostly alpha, there's a bunch of alpha, there's a few alpha plays that are higher than they were here, or at least kind of flat. So from that perspective, from a portfolio perspective, the alpha plays, saved my bacon, because they didn't go down like the trading sardines and the pre-discovery plays and any 90% of the juniors that have average to below average quality management or projects or whatever. But that doesn't matter, because we're not here anymore. We're here right now. Great Bear Creek Resources recently touched a new 18-year low, almost 18-year low. This is a company that might go bankrupt, but it is still pretty, I think it's still a pretty good proxy for the junior sector overall, because it's not the only junior out there that is down 90%. Or 80, 90% or whatever it is. Point is, excuse me, we're here right now. We're not here. We're not here, we're not here, we're not here. We're here. So if there was any time, I think beta, deep, simple, no growth value plays, some micro cappers, etc., would make a lot of sense to buy. This is probably makes most sense in the last, 6 years at least, something like that. Not adjusting for potential funding problems, but again, it's like if or let's say 6 out of 10 survive, that could more than offset the 4 that went broke. But margin of safety, and again, it's like it's easy to just want to buy what's down the most because down the most from the 52 size because you think, well, if it goes just back to that high, I'm gonna make even more in this one than the other one that's just down 60%, whatever. But again, when we're talking about margin of safety, you can't compound what you lose. A permanent loss is a very bad thing, all things considered. I mean, it's not like you can avoid it, especially in this sector. But I mean, you should really try to not be too greedy, I guess, is what I'm saying. Because I find myself that it's easy. I mean, I just thought about it. Okay, let's say I go all in 50 microcappers, etc. And let's say this sector gets worse and the funding is even harder to get by, etc. Because we know the sector is going to turn around, but we don't know when, and we don't know how much pain. I mean, it should, from a valuation standpoint, it should turn around today, right? Or if it doesn't turn around today, it should turn around tomorrow, etc., etc. I mean, they are already undervalued, so they have no fundamental reason really to go any lower, because they're already undervalued. The sector is grossly undervalued. I mean, the math doesn't add up at all. It doesn't reflect the value of the gold business at all. So I mean, that's also one thing. I think one should consider is like, from a rational standpoint, this market should turn tomorrow or today. Should start to go higher today. The bottom should be in today if it is not in already. If that's the case, I have no idea. But that's one thing. It's like we don't need an excuse for the sector to turn higher. Because from a valuation point of view, it should already have turned. It should not be down here. But it's sentiment and people who drive this sector. It's the retail people that drive this sector. And retail people are notorious for, again, 1 in 20 does not beat an index. So 19 out of 20 people do not make rational decisions, and now we're here. But they will make irrational decisions at the same time, or on the flip side, to the other direction when they, constantly buy high. Everybody loves a trend. I mean, that's the thing. Nobody wants to buy now because the trend is down. Everybody wants to buy here because the trend is up. We're simply front running this someday bottoming, some new money getting in, start of a trend. Okay, that convinces more and more people, and the more people get convinced, the higher it goes. And then all of a sudden, when the trend is up here, let's say, then max people will be bullish because they're looking at the price. They don't look at the companies. They're not selling the companies right now because they think they are overvalued. No, they fear a price. I mean, that's another point. Like, what is risk? If you ask the average investor, they say that risk is price risk. Risk is that a stock can go down. That the price of a company can go down, that is risk to them. This is price. Up and down, up and down, up and down. To me, risk is buying something that is overvalued, should go down and stay down. And maybe it's like in the case of Bear Creek, maybe the fair value is here, who knows. But it's probably not up here, even when gold was at 2000. So that's risk to me. Risk to me is buying something that no matter how long you wait, shouldn't go up. Should stay down, go down and stay down, or even go lower. And the risk of bankruptcy, that's real risk. Because it doesn't matter if this continues until, let's say this continues for like 10 months, and then we have, one of the best rallies ever, whatever. If you own companies and none of the companies are still around in 10 months, then you missed out on the inevitable mean reversion. That's real risk to me. And there are companies out there that have a lot of cash, good backing, good management, etc., and have an increasingly likely chance of returning very good returns over the next 2 to 3 years. I mean, I mentioned on K Report. I mean, there's some companies out there that has up to like, I don't know, 80% of their market cap in cash. So basically, you're almost getting your money back, or let's say 50% of your money back, and you get a very, very cheap option on 3 million ounces of gold. So basically, you're kind of hedged by buying it. You get a cheap option on gold, and you get 50% of your money back at face value. How does that not beat, what putting the money in a bank or whatever in times like this? I'm not saying you shouldn't have some money in the bank, but I hope you understand what I mean. And also, it's like, okay, where we are right now. I mean, some concepts, for example, it's like the Lassonde curve. Okay, what are we seeing out there? Cost inflation. Higher capital costs. Why? Because nobody wants to invest in this sector. The sector is volatile. Metal prices are down and rates have gone up a lot. So what does that mean? I mean, the costs of building something has gone up, and the cost of borrowing to build something or raising money through private placement, whatever, has gone up, and the NPVs, I mean, go down given that rates are up, and the needed return on investment goes up because rates are up. So it's a perfect storm right now against especially developers, because not in, I don't know how long, maybe ever, at least in modern times, has it been more expensive to build a mill or a mine. And let's say it's the rates are, well, they're not extremely high, but let's say they're highest in, I actually don't remember, but at least in 6 years, let's say. And there's no appetite for risk, etc. So it's like, that's one argument against an advanced explorer or a late stage or a developer, let's say, that have a mature project, and all they have to do, they have to do is build it. Because it's probably the hardest time ever to actually build something. If you're building it alone. I mean, if you're waiting for an acquisition and there's never an intent to build it, that's another thing, because the gold miners are typically quite cashed up. But that's one thing to think about. It's like Line 1, for example, they've had to raise, I'm assuming costs are up a bit, etc. Still, I mean, they have quite a bit of infrastructure and equipment that's already purchased, etc. They're not starting from scratch. And also like private placement right now. Right now I'm very focused in the sense that I know that times like this is where our decisions affect our future returns the most. So if there was ever a time I would, it's like recently I saw a private placement with a 3-year warrant. It's a silver company, certainly not the best silver company, but it's like a 3-year warrant at a time like this. I mean, if we get into some kind of frenzy within 3 years, maybe, just maybe, you'll get a 1000% return on that. Without it going like, extremely high. So you give money to the company so they have an easier time to be around. I mean, lowers the chance of them going bankrupt, and you get risk-free upside via warrants. Full warrants for 3 years. So let's say the strike price is here. So if we pretend it's Bear Creek Mining, if price ever reaches this point or higher in the next 3 years, your returns get supercharged. And you can look how long these extremes last. Typically not long. Once the bottom is in, they're like, choof, they go straight up in a very short time period. Sure, there's, retractions, but you typically don't see that it goes down here and then for like, that it stays down here for 3 years. No, within 3 years it had already rocketed higher and almost was down to the next, crash low. So a lot can happen in 3 years. And tops and bottoms don't last typically that long. So I mean, the asymmetrical risk reward or the risk reward profile gets asymmetrically skewed in a good way at extremes if you get, you know, full warrants, etc. Not everyone can participate in that. I understand that, but there's no shortage of opportunities out there. But I think like that company, I would probably not have bought it unless, you know, this was a private placement with 3-year warrants. If it would be a half a warrant, I wouldn't have bought it, I think. So it's like I'm not prepared to. I don't think I would be prepared to buy the stock itself. Maybe not even with a half a warrant, but with a 3-year full warrant, yeah, that changes things. But so I hope that again makes sense. That I mean, there are unique characteristics with crash bottoms. Or mistakes go exponential, or they always go exponential nearing extremes. But it's like catching one of these crash bottoms, waiting for the next sentiment high. That is enough to you know, have you. That will be enough returns to last you for a long time. But we don't know when that is. Might be tomorrow, might be in a week. They might go down 30% more. It's just that the worse it gets, the higher they will go afterwards. This was, I mean, probably the most extreme crash, at least in the last 20 years. Then it went up 2,000% in a few years from the bottom, and every buy, literally every buy, in the previous 6 years would have been in the green at the top. And this top here forgave every buy lower than this level, all the way down. And this rally here forgave every. You could have bought any time lower than this in the last X months made a return. Same thing is gonna happen because the mining sector is not going away. And I think within the next few years, I think we will break out of $2,000 gold, and we will actually have a mania on our hands. So you can think about, I mean, that's what should keep you in the game. Let's say you pretty much knew that within 4 years, let's say, we're gonna have an extreme mania. Sometime within the next 4 years, prices are gonna be up here, and we're here right now. I mean, if that doesn't get you greedy, I don't know what will. But right now it feels like this is gonna last forever. Obviously, I mean, that's how it's supposed. A bottom is supposed to be bottomless. That's how it is. But again, from a rational value perspective, miners should bottom today. And if they haven't bottomed today, they should bottom tomorrow. So I mean, keep that in mind, in my opinion, all the time now, that we are at unsustainably cheap levels and have been for quite some time. It's just getting more and more extreme. The rubber band is getting more and more stretched from the mean, and we're gonna go way beyond the mean someday. Here's just an example of, I mean, it doesn't take too many stories to actually help your portfolio a lot in terms of price. I mean, Snowline alone, for example, pretty much almost paid for the whole year. I mean, I don't know how many stocks that is paid for, because I've been really heavy into Snowline. I wish I actually saw the case even better even earlier, but I can't really complain at all. I still think it's one of the best exploration stories out there. If I look forward 1-2 years, I just see Snowline growing and growing and growing. And relative to the, I don't know what the market cap is right now, maybe 340 million Canadian. Since I think this has a good shot of becoming, a literally a tier 1 deposit, which is extremely rare. That doesn't look much at all. Although I know a lot of people think Snowline, like every exploration story, always is overvalued. But that's the thing. It's like the market is trying to, in these cases, trying to predict the future. All exploration stories tend to be overvalued based on what is confirmed, but not based on what is known. Based on what is confirmed, Snowline has, I don't know, 8 assays out. Based on what we know, it looks like it could be a 10 to 20 to 30 million deposit, and has a reasonably good chance of that being in black and white one day. And relative to that, it doesn't look expensive at all. Western Alaska also, like, very high insider ownership. I think insiders own like 41% of the stock. I mean, they have huge skin in the game. So if you're worrying about the stock or the company, I mean, imagine how much they are working and worrying about creating value. Long pipeline for growth. I think that could, grow for years to come. But these two alone has, Western Alaska for some time there was I think it was a 700% return or something, with a pretty big position, or a decent position at least. So just these two stories has paid for I don't know how many. I probably own like 20 stocks. Let's say they're down 70%. Let's say they make up 20%, 1% in each. So that's 0.2 times 0.7. That affects my portfolio by -14. Whereas these two alone have made up more than 20%, and they're up. So they've already paid for like 20 stocks or more that are down 70% or more. Some I think are down 90%. But it is a big difference between a high conviction case. The big high conviction case that punished me, that was Novo. But I've made more in Snowline and Western Alaska than I lost in Novo on paper. So it's like, you don't need perfection at all. But when an opportunity is really good, you think it's really good. There was no guarantee that Western Alaska or Snowline would do what they've done. It was just based on probabilities versus what I was paying. It felt like it was good risk reward. I don't even know in hindsight, how high quality my buy decision was, because we only see the results. Snowline is up and is having great success. Western Alaska is up and is having great success. That's all I know. There were never guarantees that would come to pass. So we can't take anything serious, personally. Just because you make money on a stock doesn't mean you made a great buy. Just because you lost money on a stock doesn't mean the buy wasn't good, etc. It's over the long term. Our long-term results are going to shed light if we actually have been making more good decisions than bad decisions. That's the only way, really, because nobody knows the exact chance of success for anything. And Goliath, that has traded sideways pretty much over the last 1 year, something. Eloro traded sideways 1.5 years. That might not sound like a lot, but if they're just even when, some stuff is down 80-90%, obviously you're outperforming. And again, you could, if you would want to, let's say you're down only 30-40%. Sure, and I'm talking from the sentiment high, because everybody focuses on that. Let's say that you're down 50%. I don't think that's going to be a problem. Some of these juniors are going to go up way more, like they always do, from these bottoms. 50%, that's going to be a piece of cake. You're probably, some of the micro cappers I bought, they might go up 500%. There's think about it. If you're down 50%, you only need a double to get into the green. And there's de-risked, high-quality stories out there. They're like the top of the line. I think, for example, Snowline could, when we go into the next sentiment high and that stock or that company just keeps on creating value, unlocking value, I could see that become a 10-bagger. Way more than 100% return, at least. Same with Eloro, same with Goliath. Goliath looks to have a huge system. What's that going to be worth in a hot market? One of the, let's say, largest underground high-grade systems, potentially, could easily be worth a billion in a hot market. It's just that it feels right now that 100% return is so, out of the realms of possibilities. Because nowadays, a 10% return feels like that. But that is gonna flip. And typically it flips way faster. I mean, typically the upturns are quicker than the downdrafts. That's why the downdrafts suck even more. And like this sector is like 80% of the time it sucks. And 20% of the time you get rewarded for sticking in although it sucks. Because nothing stays this cheap forever. Nothing stays this overvalued forever. It's gonna ping pong until the day that humanity is gone. And here's just an example. It's like Eloro, for example. It's a funny thing. It's like we're frustrated when we see stocks go down 80%, obviously. We're also frustrated when we're seeing value creation happening. It's like the last news release. They put out, extended the high-grade feeder zone by 400 meters. A whopping 400 meters. That is a lot. That is a lot. Or confirmed strike, perhaps it was. Anyway, it's like added, obviously, a bunch, many tens of millions, if not 100 million of inferred risk-adjusted value. But the stock hasn't really done anything since early 2021. So what's happening here? I mean, this is frustrating. Why? Because the ones who have had a bullish view on Eloro, meaning that we think this is going to grow and grow and grow and grow. This is going to be one of the largest systems ever found. So far, that is looks to be increasingly true. And yet we're not getting paid for it on paper. So before our eyes, value is going, or has been going up for years. But for almost 2 years, price hasn't gone anywhere. What that means is that whereas a trading sardine, which does not create a lot of value, and let's say, dilutes, etc. So you actually have a slightly downsloping value curve if you account for the dilution over time. This ping pongs up and down, crashes and rips 500%, crashes 80%, rips 500%, etc. etc. This is frustrating because it's going straight down and it's down 80% from this level. This is frustrating because you've been, the case has played out like you'd hoped it would, and still you haven't gotten anything for it. So it's just funny in a sense that even though this is absolutely, Eloro has absolutely been killing the GDXJ, for example. So people would think that, hey, we should be really, really happy. I mean, GDXJ is lower now than it was here. Eloro is up here. But that's not how our brain works, understandably so, because we see that, hey, I mean, this case is playing out. But that again doesn't mean that just because Bear Creek Mining is down 80% and Eloro is not, does not mean that Bear Creek Mining is cheaper than Eloro. Because there's a reason why Eloro is not down 80%. It's because the company is creating so much value at such a rapid pace. That value has gone on a relentless uptrend. But sector sentiment, like we can see using Bear Creek Mining as a proxy, has gone straight down from this point in time. And first it actually withstood it, but then it kind of sentiment prevailed, etc. So from this period to this period, sector sentiment has just been going lower and lower and lower, and in case of Bear Creek Mining to a 14-year low. So the result is you have a expanding price to value gap for Eloro. As sentiment got worse, but value got higher, pulled up, let's say, pulled up price enough at least that it just stayed flat. But it still means that the price to value gap has been expanding over the last year. So I wouldn't say that, and again, I mean, think about it from this perspective. Bear Creek Mining, yes, it's probably cheap, yes, it's probably gonna go up a lot, etc. Is that a world-class asset? Is that something that a miner would really want to own? I mean, it's been around for almost 20 years, so it would suggest that no, that is actually not, they own a mine now, of course, but like their legacy silver projects are not that great, not that enticing, because it's been a trading sardine for 20 years. I would much rather own Iska than I would want to own their silver deposits, for example. Sure, I mean, Iska is a polymetallic system, but it's simply a better system. That's, I mean, it looks like it would be a much better deposit setup, much more value. So even though Eloro has gone sideways, this might be a lot cheaper than Bear Creek that is down here. And just, lastly on the point of how I go about things, opportunity trading, because like I keep saying, I mean, just because you have no dry powder does not mean, since I'm fully invested all the time, yet my portfolio, although it crashes like Bear Creek, well, not like Bear Creek, but like, yes, my portfolio crash 50% or more every 2 years or so. This was like, and I started buying here, but this was like 54% down. I think this was like 56 or something. Now I don't actually know, because I haven't even updated. I don't know what my portfolio has been doing, because I own private placements and stocks via my company and stocks personally, and I don't care too much, because it's like, it doesn't matter what has happened, it's matter where we're going anyway, and it's just gonna keep you even more short-term oriented or obsessing about what's happening in the portfolio. Instead, we should focus on making the best decisions with what we have, and right now that's been, if you're fully invested, have been decreasing indirect dry powder amount, because if you're fully invested, you see stocks go down. That doesn't matter really, because you can still create value even though your portfolio is down. If you have 10 stocks, all of them are down 50%, 2 of them have actually created value, 2 of them have not created value, 6 of them have actually decreased in value or something like that. Obviously, that's a big opportunity. You could simply sell at least 6 of them and pile into the ones that are down as much but have created a lot more value, because they're going to go up way more. So without anything happening to the portfolio at face value, you're still down 50%. If you had $10,000, you still have $5,000. It's just that you're going to have a lot more in the future than before you actually reshuffled. So you're creating future wealth. Even though at face value, you don't have to put any money into the portfolio. So again, this is no time, I think, to be lazy or anything, because it's at times like this that even relative, the relative quality of cases within the sector, they also go exponential. One stock shouldn't go down 20%, but goes up down. One stock that goes down 20% that is already extremely cheap. One stock maybe goes up 5%, but it's not extremely cheap. Obviously, that's an arbitrage opportunity. I'm pretty much like Warren Buffett is when he was younger.
When you only have $10,000, that can get a little frustrating. And if you don't like to borrow money, which I never like to borrow money, so I was always coming up with more ideas than I had money. So I had to sell whatever I liked least to buy something new that just was compelling to me. And for a long time, I was in that mode. And now our problem is we have more money than ideas.
So that's I guess I suspected that he would be doing something like that. But that's what I find so funny. It's like in the last video I talked about this, Charlie Munger quote: "If you can stomach a 50% retracement, you deserve the mediocre returns you get." And a lot of people don't understand that at all. And most people can't understand how I can be constantly all in. But that's what Warren Buffett is talking about. When he had a small amount of money, or small enough amount of money that he could literally get in and out, etc., out of stocks, he was fully invested all the time. He was always concentrated in the best place he could find. And when prices changed, or he found a company that was better than the worst company he owned, for example, he sold that. So he was creating future returns all the time, yet he was fully invested. Just by reshuffling and reshuffling. As soon as opportunities, excuse me, kind of like this. At this point in time, you have this opportunity set. These are the price to value gaps here. Okay, this is the only one that's actually fairly valued. The other ones are expensive. But let's say you wanted to be in the section, you own these three. Okay, it goes down, and now these are the cheapest ones. Then you can reshuffle, and then we 1, 2, 3 more months forward, something else happened, etc. And you reshuffle again. Without any more dry powder, you're affecting your portfolio anyway. You're creating future returns, higher future returns, by using currency from one of your, let's say, worse conviction plays or lower conviction plays to buy the highest conviction place. And that will change given, maybe this was the best buy here, for example. This was the cheapest, let's say, and that goes up here. And this green one just goes up here. Then you can sell that. It's made a good amount of money for you already. And now it's not even cheap anymore. But at the same time, I don't believe too much in over trading, let's say, because that's so easy to do. Because, for example, it's like, especially, Snowline, for example, even though you don't know exactly what that's going to turn out to be, I can, there's probably going to be, or has a good shot of becoming a tier 1 deposit, etc. So it's like, and if that happens, based on what we know, that looks, like a good bet. So in that case, that's very undervalued. So I don't care. Let's say it goes up 20%. Does that break the case, or is it all of a sudden not cheap enough? No. If you think it's gonna, you have to compare it to what you think it's gonna be worth someday. If you think Snowline is gonna be worth 2 billions or 3 billions within 2 years, that's what you're working with. The current price relative to that future you foresee, or the balance of probabilities you foresee. So that's going to take quite a bit to it has to run quite a bit for that to be expensive relative to if the case is intact and you're sticking with that 2 billion. It's like Western Alaska, for example. That could one day be a high grade 1 billion net present value deposit, I would think. And it could go way beyond that if they that's just based on what they can find in maybe 1.2 kilometers of strike, let's say. So it could go way beyond that. But the fundamentals change with news. The fundamentals doesn't change with price. Price changes every day. Fundamentals doesn't change every day. So as long as the case is intact, the volatility in the price is just going to change the price to value gap until we get the next news item, which will change actually the value. So maybe They find a new zone where this is a lure, of course, but you know what I mean. So it's like any day we don't have news and price goes up or down, that's affecting the opportunity. That's not affecting the fundamentals of the case. One last thing is why I tend to discuss what I'm bullish on versus what I am selling. There's a pretty simple reason for that. Since I'm always 100% invested, means that if I find something that's like, let's say when I really dug into Snowline, for example, like Jesus, I mean this could be, Fort Knox on steroids, for example. I obviously had to sell shares of other companies, lower conviction companies, and in that particular case, Snowline was the highest conviction, so I would be okay selling whatever. That obviously doesn't mean I'm bearish on my second highest conviction case or anything like that. It's like with insiders buying and selling. There's a million reasons for any insider to sell, but there's only one reason for them to buy. They might sell because they found another investment opportunity or needed money for the house or for taxes or for a wedding or a car or whatever. They're buying because they think that money is best placed in this particular stock they're buying. So otherwise, let's say I shed some shares of 20 companies to buy Snowline, and I was like, yeah, I'm selling, stock, stock 1 to 20. How does that help anyone? I'm not a market timer. I just like Warren Buffett. I might own 30 companies. I'm really excited, really excited about 5. So those might be my core positions. I mean, typically just a few stories I own typically makes up 40-50% of my portfolio. And thankfully, those have been stories like Snowline in the recent past, for example, and Goliath and Lure before that. And Western Alaska became a very big position because I didn't really, take any profits for a while. And it's still a big position because even though I'm up on it, I took some I don't think I took profits here. I think I took some profits here actually to buy some more Snowline. But that again is like Western Alaska, one of the best cases I know. It's just that at the time I was so underweight in Snowline that I even had to sell some of Western Alaska here. But I've actually added some Alaska during the bottom. Again, I'm letting the market come to me. If nothing happened with Western Alaska and it goes down 60% from the top, I obviously like it a lot more here than up here. But I think, if the case plays out, you're gonna make money from here. Like in Great Bear. At the end of the day, any buy you would have done ever in Great Bear ended in green. Some of these stories are gonna play out like that. They're actually gonna be acquired at an all-time high, hopefully. Especially since if they can keep growing, etc. I hope all this made sense. And it's like, don't take anything personal. You are not stupid because you're down right now. You are not stupid because your portfolio is down tomorrow or the day after that, or it goes down 20-30% extra from here. The market is absolutely stupid right now. You're not stupid if you're buying this sector down here. You're one of very few that is actually smart enough to understand that 30% up or down here, throughout history, that has never mattered. Because when this sector rallies, it rallies a lot more than 100%, especially in juniors. Especially in juniors that have increased their value during this downtrend, where the value is going up, and let's say some price has gone down like this with sentiment. This is the free value you're getting right now, which will get priced in one day. So I understand if one isn't bullish given the recent past or anything like that. You should be very bullish given. Ask yourself, where do you think the sector will stay this low for the next 3 years? I mean, look at COMEX, silver and gold. I mean, that's getting drained. The sector is so crap that there's no really big supply coming on. So everything is, from a fundamental perspective in the metals themselves, I think their best days are ahead. And if their best days are ahead, and this sector, the actual mining sector, is pricing in the worst times ever and forever in the future, obviously that's a big opportunity. This sector isn't even pricing in today's gold price or today's gold business. And again, the supply-demand picture appears to just be becoming better and better and better and better. So it's like at no point in history has it made sense selling a sector that has crashed and is way undervalued. You always make money. It's just a matter of when. But again, that's the important thing. Most people don't see it that way because they use this past as a reason for not being in the sector. So they don't see the opportunity at all. They just see a never-ending trend. But anyone who has looked at any chart of any commodity sector knows that this is exactly what happens. They crash and rip, crash, rip, crash, rip, crash, rip. We're gonna, one of these days, this sector is gonna bottom, and we're gonna be in the next, multi-month to multi-year uptrend. That's just how it is. I didn't make the markets. God made them so. Yeah, thanks for listening. Assume I'm biased. Don't consider this to be investing advice. Assume every company I talk about that I own them. And, I'm sponsored by Eloro, Snowline. I don't know how many I talked about. Goliath. So again, do your own due diligence. Don't buy anything because I'm bullish on them or own them or whatever. You gotta see the case yourself, because otherwise, again, if you're excited about the company, that you personally would like to be a owner of it, that you see the value, that's when you're gonna make good decisions. That's gonna get you the conviction to buy cheap and sell expensive. Otherwise, if you're not excited about the fundamentals of the company, you're gonna be scared when price goes against you, because you're gonna believe that the market is right. Yeah, thanks for listening. Hit the thumbs up. Bye.